Alright guys, chapter 9. And after we go through this chapter, I'll talk about that Goldman Sachs letter too, because that's still relevant. Chapter 9 again on distribution, the direct bank and institutional channels. Again, a lot of this is going to be similar to the things we discussed in the last chapter, so I'll try to go through this quickly. During the 90s, it became more popular to offer mutual funds through more than one channel. Just like any product, right? Yeah. Are you better off selling your product through one retailer or many? Many. Exactly. Okay. The drive to sell through more than one channel created more competition, right? This chapter will discuss the many ways mutual funds are distributed. Okay. The direct channel. No intermediary provided advice or service. So when you go to the direct to the mutual fund, they're not going to tell you which one's best or which one's worse or which one fits your needs better based on your age and risk profile. You're just going to call up and say, I'd like to buy this many shares of this class, and here's my account number, and I'll wire you the money, right? However, there are no commissions charged on the transactions. So there's still a management fee, right? And that could be a multiple choice or a true and false question I asked. I can try to trick you guys with confusing management fees with distribution fees. But there are no loads on a buying the funds directly. Okay? Regular management fees still apply. Okay? The direct channel encompasses fund supermarkets, financial planners, wrap accounts, and defined contribution pension plans. Pure direct marketing. Fund companies sell directly to the investors without the aid of an intermediary. So that means they're not even going to do it with like a fund supermarket or anything. They're just going to, this is a pure direct marketing is literally the picking up the phone and calling.
It's kind of like the primary market.
Yeah. And how do investors find out about it? Through advertising. Investor requests a prospectus. Investor sends funds to invest. Fund transfer agent interacts with the client. Redemption orders are communicated to the transfer agent. So it's a very direct process. Okay, we'll just go back to this slide real quick. The direct channel where there's no loads can apply is in fund supermarkets. In some cases, financial planners, but not always. I just want to go back and say that. Okay, supermarkets. Okay, Charles Schwab originated this concept in the early 90s. Charge investors based on transactions, right? $12.99 to make a trade, right? I think now it's been lowered a lot of times. It's $9.99 to make a trade, or there's different promotions depending on how much money you invest, right? They might give you free trades for your first 25 trades. Why? They're all incentives to what? For you to open up an account, okay? Convenience of having all investment transactions in a single place, right? Everything gets funneled through Charles Schwab. Makes your life easier. You don't have to be like, oh man, who's that other fund? And I have that other fund through this company. Everything's centrally located with Charles Schwab or whoever the fund supermarket is. It makes managing your money easier for you. In 2002, there were 30 fund supermarkets, E-Trade, TD Waterhouse, Schwab, etc. Funds have to rely heavily on advertising and also fund performance. Why? What do investors look for? They look for the highest return on the fund. Funds have to rely heavily on advertising and fund performance. Fund performance levels a playing field for smaller firms. If they perform well, they will be noticed. Okay. Financial advisors and brokerage wrap programs. Fee-based advisors offer investment advice on financial products. Typically, they get 1%, right, of the assets they manage. So they'll charge that fee annually, right? And they'll accrue the charges daily, just like anything else, right? They will help funnel money into the direct channel with no loan funds. Conflict of interest is reduced as clients pay a flat fee. So the client's paying the flat fee. They're not getting commissions from the mutual fund. So this helps eliminate some of that conflict of interest, where if you're just paying the financial advisor directly that fee percentage, and he's not getting paid from the mutual fund firms, he should, in theory, act in your best interest, right? Because he wants to keep you as a client, keep you happy, etc., etc.
No, doesn't FINRA, don't they take away these people's license for putting you in investments that has nothing to do with what your needs are?
Repeat that?
They could get in trouble for that, right?
Oh, by just selling you stuff that's not meant for you?
Yeah.
Yeah,
because
of course.
You're getting more commission.
Yeah. That's against the rules. But however,
How is it?
it's not hard. It's not hard to figure out. But
They have to give you kind of like a test.
yeah, there's an annual review on your account in terms of identifying your risk profile, like what you want for retirement, how much money you want to have, and they have all these like kind of preset formulas with big institutions on like basically a formula like, all right, kind of like if you've done your taxes through TurboTax, you answer all these questions, and at the end it gives you a result. So you answer all these questions to the financial advisor, and at the end they'll have a mathematically computated risk profile, which says like, all right, looks like based on your age and your income and the age you want to retire, you should have 15 to 25% of your assets in this category, 30% of your assets in this category, etc. In a wrap program, a client turns over their assets to a brokerage firm who manages their mutual funds, rebalances as needed based on an investor's situation. Defined contribution pension plans, commonly referred to as 401k plans or DC plans, account for a third of assets in mutual funds. We talked about this earlier in the semester, how important defined contribution plans were to the growth of mutual funds, right? It helped create more competition. It helped broaden the asset base, right? Because instead of just having a bunch of 500 or 1,000 or even 10,000 big firms making all the investment decisions for their pensioners, now we have millions and millions of people making their own individual decisions for their retirement, right? So there's a lot more money on the table for mutual fund firms. Expected to grow as employees move away from providing pensions. So this is a challenge to some firms. My firm right now, we basically market towards institutional investors. We sell to pension funds. What's happening to pension funds?
Moving away.
They're not going away completely. There's some places where they'll probably always be pension funds, like firemen, teachers, military, police, hospitals, high-level executives, etc., etc. But generally, there's a move against pension plans. Why? Because of the liability it places on the company. The company would rather just pay you weekly into your retirement, and then when you quit, they're done paying you, right? The intermediated channels, retirement plans, attractive segment for firms as the assets are more sticky, right? It's like opening an account. Like how many people here have Bank of America? Okay. How many people here don't like Bank of America? Why didn't you switch?
I said
All right, you did.
convenience.
Inconvenience, you mean?
Convenience. I travel a lot.
There's plenty of other banks out there that don't charge.
I know, but if I need to do, let's say,
See, you can't even think of a good reason.
let's say if my sister has my bank card to take out something for me, I could easily go from my saving into my checking, and she can just use it. Or if I need money, somebody's in another state, they can easily put it in there for me.
Exactly. That's what
They're everywhere.
I think with the proliferation of technology, like I go to Cambridge Savings Bank, and they don't charge any ATM fees anywhere I go. They reimburse me for all ATM fees. And what's that?
Now.
They suck.
What?
Cambridge Savings Bank.
No, they're awesome.
No. There's one time I probably had like 15 transactions within one day. They froze my bank account. When I went to a restaurant at the end of the night, because it was suspicious that my bank account had so many transactions.
Oh, well.
And they did it numerous times.
That's happened.
Screw this.
That's happened with, I think, everybody's bank at one part or the other. No, it's not.
Never
All
happened.
the saving account did.
Think about
Yeah,
it.
that's
What
happened.
with it.
I thought you were going to say some real devious story. I mean, they charge me fees for whatever that I
They
probably
suck, right?
all right, moving on. We can talk about this after the video. We shot the video. Personal finances, okay? But all I'm trying to say is that you guys, once you have an account, it becomes very difficult to switch accounts because you have to switching accounts. You have to like reroute all your like electronic billing, and you might miss one and then miss a payment on something. It's a pain in the butt. It's not like an easy process. Same thing goes for retirement accounts. Once you open the account, it's very easy to keep everything there, right? Investment advisors, broker wrap programs, we already went over this. Advisors sell financial products and collect a transaction-based fee. Insurance used in DC and annuity plans. What's an annuity plan?
Plan where money's being, you either put money in it continually, or you get paid.
It runs a lot like an insurance scheme, right? It's like what you typically think of an insurance scheme, right? You pay in like once a month or once a week, and then there could be a big payout at the end. It also works in reverse, right? With insurance companies can often, like if you win big on the lottery, right? What can they offer you?
And I know
Well, lump sum.
pay you like
Or a lump sum, right? And how do they calculate the lump sum? It's like a reverse annuity, right? Like, all right, well, you're going to get $30,000 a month for the next 30 years, or we can pay you, $3 million. Banks, other brokerage and trust units. I wouldn't focus too much on this. The institutional channel seeks organizations, not individuals, as shareholders. High minimums and lower fees. That's the big difference between institutional investing and us. Okay. What institutions invest in mutual funds? They list a bunch of institutions here. Basically, any kind of institution can invest in a mutual fund, right? Bank trusts, managing individual wealth, corporations, nonprofits, retirement plans, right? And that's it. That's it for chapter 9. So, let me pause this real quick.